So over the weekend, we celebrated an anniversary, and this is the anniversary of the current bull market that we're in. It's Tuesday, October 15th, and we just wanted to kind of give a recap of what we've seen over the past 2 years, and then from a bull market perspective, what we expect going forward as we enter year 3. So let's look at some of the impressive factors we've seen since the bull market started on October 12th of 2022. The S&P 500 is up almost 70%. Now, it hasn't been as broad-based as we'd like to see, because if you look at, for example, the Russell 2500, which is mid-cap stocks, they're only up about 40%, as well as small cap stocks. They're also up about 40%. So we haven't seen as much participation broadly across the market cap sectors. It also hasn't even been that diversified in the large cap space. When you look at the S&P 500, the market cap weighted index is outperforming the equal cap weighted index by about 22%. And that's because the returns have been made up about 5 different names. These 5 names, which are NVIDIA, Meta, Broadcom, Microsoft, and Apple, they've made up 96% of the total return we've seen since this bull market started in 2022. The other thing is this has been primarily PE expansion. So people are paying more for those earnings for these high tech and high growth and tech names. About 75% of the total return has been made up of PE expansion, while only about 12% has been made up of actual earnings growth. Now, when you look at this bull market and how it measures up in comparison to last bull markets, we looked at 15 different bull markets since 1932. And what you tend to see is the median average return as we start to enter that third year is about 55%. And we've been up again, as I mentioned, about almost 70% in this bull market. Now, how much further can we go? What we tend to see, if you just look at history, that is in year 3, the bull markets start to lose steam. So if you look at those 15, of the 15, 10 of the 15 make it to year 3. Only 5 of the 15 made it to year 5, Now, when we go and look at the returns, what you tend to see is the average return in the first year is about 34%. And that compares to what we saw in this bull market, which was 22%. So we lagged a little bit in the first year. However, the second year, the average return you tend to see is about 10%, and we've been up 32% this year. Now, year 3, as we mentioned, is when the returns start to lag, and the market's up about 5%. But as we mentioned, less and less of these bull markets make it to year 3, 4, and 5. So what do we see going into this third year? We think obviously returns can be muted if you just look at history, but there's also a lot of risks that are mounting in this third year of the bull market. Not only do we have uncertainty about the flexibility the Fed has, we have a presidential election coming up, we have a geopolitical tensions that continue to roil the markets, and then let's not forget that we have, from the economic standpoint, that economic growth is expected to slow as we go into 2025. That's all we have today. We'll be back with more economic data. Tomorrow's a big number. We'll get the retail sales number. So we'll be back tomorrow with some more information for you on the markets. If you like this podcast, please, hit that subscribe button, hit the alarm button, share this with friends or colleagues. And if you'd like further history of our podcasts, you can go to marketswithmegan.fm. Thank you.